All right, so you want to know what's happening with commercial real estate in Texas?
Mm,
Well, we got this email newsletter from Eureka Business Group.
okay.
It's a brokerage firm down there.
I see.
And it's like a little window into the current market, right?
Yeah.
And maybe even like a crystal ball for what's coming next, right?
Right.
So is this a sign of a true turnaround or just a few lucky breaks? Let's dive in and find out.
Yeah. Sounds intriguing. Yeah. I'm always interested to see how different markets are, performing
Right.
across the country.
So they lead off talking about, this positive sentiment
Right.
in the market, right?
Sure.
Investors are back.
Right.
And even more importantly, right, lenders are opening their wallets again.
That's huge.
That got my attention right away.
Yeah. That's definitely a shift, right?
Yeah.
Positive sentiment often translates into more deals, higher prices, and a general sense of, optimism.
Right.
It suggests that people are, seeing potential for growth and are willing to take some risks.
But is this just hype or is there something more substantial happening in Texas?
Well, that's what we need to figure out.
Right.
One thing that might be fueling this positive sentiment is the availability of construction loans
Mm-hmm.
at around 7%.
Okay.
Historically, lower interest rates can spur new construction projects,
Right.
which can have a ripple effect throughout the entire economy.
Okay, so new construction projects,
Yeah.
more jobs,
Uh-huh.
more businesses, right?
Right.
That all sounds good.
Yeah.
But there are always two sides to every coin, right?
Oh, absolutely.
What are the potential downsides to this?
Good point.
Yeah.
Lower interest rates can also lead to, overbuilding
Right.
and inflated asset prices,
Uh-huh.
creating a bubble that could eventually burst.
Right.
I mean, we've seen that happen before in real estate cycles.
So it's not all sunshine and roses.
Exactly. It's important to look beyond the headlines and understand the underlying factors driving these trends.
Right.
And speaking of headlines,
Yeah.
the newsletter highlights some interesting listings of the week.
Okay.
They've got everything from child care centers to Dollar Generals.
Which one caught your eye first?
Well, the one that really jumped out at me was the Starbucks
Okay.
with over 40,000 vehicles passing by every single day.
Wow.
That's a lot of potential customers.
That's like location on steroids.
Right.
Yeah, but I'm curious, even with all that traffic, isn't investing in retail risky these days?
Yeah.
With, online shopping and all?
You're right.
Yeah.
The retail landscape is definitely changing.
Right.
But remember,
Yeah.
Starbucks isn't just any retailer.
Right.
They have a loyal customer base
Uh-huh.
and a strong brand.
Right.
And a high traffic location like this one can still generate, significant foot traffic.
Right.
Especially if it's, a drive-through.
Right.
But of course any savvy investor would need to look beyond the traffic count.
Okay.
They'd want to know about the lease terms,
Mm-hmm.
the operating costs,
Right?
and the average sale per customer.
Okay.
They'd need to calculate something called the capitalization rate
Mm-hmm.
or cap rate
Okay.
to assess the potential return on investment.
Cap rate, is that like how much bang you get for your buck?
That's a good way to put it.
Okay.
Basically, it's a measure of the property's net operating income
Okay.
as a percentage of its value.
Right.
It helps investors, compare different properties and assess their risk
Yeah.
and potential return.
Got it.
Yeah.
So it's not just about the sizzle of a busy street. It's about the steak, or in this case, the latte.
Exactly.
Now, another listing they highlighted was a 2023 built child care center
Okay.
in a what they call a hot growing town. And honestly, that one made me scratch my head a little.
Why is that?
Well, I understand the demand for childcare is growing, right?
Yeah.
But isn't the childcare business notoriously tough to profit in?
It can be.
What makes this opportunity stand out?
That's a great question.
Yeah.
While it's true that the childcare industry can be challenging,
Right.
this particular opportunity might be worth a closer look.
Yeah.
The fact that it's a newly built center
Mm-hmm.
in a growing town suggests that they've done their homework and are anticipating future demand.
Right.
But you're right. We'd need to dig deeper into the financials,
Mm-hmm.
the licensing requirements, and the local competition to really assess its viability.
So we've got a high traffic Starbucks on one hand,
Okay.
and this potentially risky but also potentially lucrative childcare center on the other.
Right.
Are these listings just anomalies, or are they telling us something about the broader trends in
Yeah.
Texas real estate?
That's the million-dollar question.
Yeah.
To answer that, we need to, look beyond individual listings and consider the bigger picture.
Right, and that brings us to Joseph Goslan.
Okay.
He's the principal of Eureka Business Group,
Gotcha.
and he's offering a free
Uh-huh.
BOV service
Okay.
for commercial property owners.
All right.
And I have to admit, I had no idea what that meant at first.
You mean a broker opinion of value?
Yes.
Okay.
Apparently, he'll give you a detailed valuation report
Right.
for your commercial property.
Yeah, that's actually a pretty valuable service.
Okay.
Even if you're not planning to sell right away,
Right.
knowing the true value of your asset
Uh-huh.
can be helpful for a lot of reasons.
Like what? Fill me in, because real estate's not exactly my forte.
Well, for starters, you could use a BOV for tax planning purposes.
Okay.
A professional appraisal can help you challenge your property tax assessment
Uh-huh.
if you think it's too high.
Mm-hmm.
You can also use it for refinancing.
Okay.
If you're looking to get a better interest rate on your mortgage,
Right.
a recent appraisal can strengthen your case.
Right.
And of course, it's always good to know what your property is worth, just for your own peace of mind.
So even if I'm not buying or selling anytime soon, getting a BOV could be a smart move.
Absolutely.
Okay.
It's like getting a free checkup for your investment.
Hmm.
It can help you, identify potential issues,
Right.
explore different strategies,
Uh,
and make informed decisions about your property.
Okay, so we've got positive market sentiment
Yeah.
fueled by low construction loan rates,
Right.
a mix of intriguing listings,
Uh-huh.
and this offer for a free BOV.
Right.
Where do we go from here?
Well, I think it's time to, unpack some of these listings
Okay,
in more detail.
right.
Let's start with the child care center and see if it,
Huh.
lives up to the hype.
Sounds good to me. All right, so we're back and ready to take a deeper look at this child care center listing.
Okay.
It's described as a 2023 built 11,113 square foot facility in, you guessed it, a hot growing town.
Okay, let's break this down.
Okay.
The fact that it's newly built is a plus.
Right.
You're not dealing with outdated infrastructure
Right.
or potential hidden problems.
Right.
And a larger facility like this might offer economies of scale,
Okay.
allowing the operator to potentially generate more revenue
Uh-huh.
and spread out their fixed costs.
That makes sense, but I'm still hung up on this hot growing town thing.
Yeah.
They throw that phrase around a lot in this newsletter.
Right.
What makes a town hot and growing?
Yeah.
In the context of commercial real estate.
Well, a few things.
Okay.
You'd want to see, strong population growth,
Mm-hmm.
ideally driven by people moving in for jobs or a high quality of life. You'd also look for, robust job creation
Right.
across diverse industries, not just reliance on, one or two big employers.
Got it.
And you'd want to see a healthy housing market with,
Right.
new construction and rising property values.
So it's not just about bodies, it's about the right kind of bodies.
Right.
With jobs and money to spend.
Exactly.
But even if a town checks all those boxes,
Yeah.
how does the location of this specific childcare center factor in?
That's crucial.
Yeah.
Ideally, it would be, conveniently located near residential areas.
Right.
With young families,
Huh.
maybe close to schools or workplaces.
Right, yeah.
Easy access and visibility are key for any business.
Right.
Especially one catering to busy parents.
Okay, so we've got a new facility in a potentially thriving town,
Right.
in a possibly convenient location. But let's not forget, this is the childcare industry we're talking about.
Yeah.
What are the red flags an investor should watch out for?
Kaleni. Okay. First off, what's the competition like?
Okay.
Are there already, several established childcare centers in the area?
Right.
Or is this one, filling a gap in the market?
Yeah.
Oversaturation can really hurt profitability.
Right, because even if a town is booming,
Yeah.
there are only so many kids to go around.
Exactly.
Yeah.
Licensing and regulations.
Okay.
Every state
Uh-huh.
and sometimes even individual counties
Right.
have, specific requirements for childcare centers.
Right.
Everything from staff to child ratios
Right.
to safety protocols.
Okay.
These can be complex and costly to comply with.
I'm probably constantly changing, right?
Exactly.
Yeah.
Investors need to understand the regulatory landscape
Right.
and factor in those costs.
Right.
And then there's the labor market.
Okay.
Finding and retaining qualified childcare professionals
Right.
is a huge challenge in this industry.
Yeah.
Wages are often low, turnover is high,
Right.
and the work itself is demanding.
Yeah, it's not just about building a nice facility.
Right.
It's about finding people who genuinely love working with kids
Yeah.
and can provide high quality care.
Absolutely.
So this child care center investment,
Yeah.
it's not as straightforward as it might seem at first glance, is it?
Definitely not.
Yeah.
It's a sector with potential, but also inherent,
Right.
risks and complexities.
Right.
Investors need to, do their due diligence, understand the local market,
Right.
and carefully assess the financials before jumping in.
So maybe not one for the faint of heart.
Right.
But speaking of unexpected opportunities,
Yeah.
there was another listing in this newsletter that really caught my eye.
All right.
A Dollar General. Now, I'll admit, I don't usually associate Dollar General with hot investment opportunities,
Right.
but they seem to be doing something right.
You're right to be surprised.
Yeah.
Dollar General has actually been a surprisingly strong performer in recent years. They've been expanding strategically,
Okay.
often targeting rural or underserved communities
Okay.
where there's, less competition
Right.
from big retailers.
Okay, so they're going where the Walmarts and Targets aren't.
Exactly.
What else is driving their success?
Their business model.
Okay.
They focus on value and convenience,
Right.
offering a limited selection of everyday essentials
Right.
at low prices.
Okay.
That resonates with a certain segment of the population,
Mm-hmm.
particularly during, times of economic uncertainty.
So when people are feeling the pinch, they're more likely to head to Dollar General?
Exactly.
Okay.
And their smaller store format allows them to operate with lower overhead costs,
Right.
which means they can, offer those low prices
Uh-huh.
while still maintaining profitability.
Interesting. So this Dollar General listing,
Yeah.
it's in a retail-heavy location,
Okay.
which I guess means there are already a lot of stores around.
Right.
Doesn't that create competition?
It does.
Yeah.
But remember, competition isn't always a bad thing.
Right.
It can indicate a healthy retail market
Right.
with enough, consumer demand
Mm-hmm.
to support multiple businesses.
Right.
The key is differentiation.
Sure.
What does this Dollar General offer that other stores in the area don't?
Well, the newsletter mentioned something about an investment-grade tenant
Okay.
and an early 5-year extension.
Right.
What does that tell us?
Those are actually very important details.
Yeah.
Investment grade tenant means that that Dollar General as a company has a strong credit rating
Okay.
and a proven track record
Yeah. Right.
of paying their rent on time.
Okay.
That's a huge plus for an investor
Right.
as it reduces the risk of vacancy
Ah.
or late payments.
So it's a stable and predictable income stream.
Exactly.
I like the sound of that.
Yeah. And the early 5-year extension is also significant.
Yeah.
It means that Dollar General is committed to this location for the long haul.
Right.
They're not planning to pack up and leave anytime soon.
Right.
Which provides, even more stability and predictability
Right.
for the investor.
Wow. I'm starting to see Dollar General in a whole new light.
Yeah.
But even with a strong tenant and a long lease,
Right.
what are some of the potential downsides to consider with this type of investment?
Well, one thing to consider is the overall economic health of the community.
Yeah.
If the area is, struggling economically, even a discount retailer like Dollar General might see a decline in sales.
That makes sense. You can only cut prices so low, right?
Right.
Yeah.
And another factor to consider
Yeah.
is the potential for future development in the area.
Okay.
If a new Walmart or Target were to open nearby,
Right.
that could definitely impact Dollar General's business.
So location, tenant strength, and future prospects.
Uh-huh.
It's a lot to juggle.
Yeah.
It seems like there's always more to the story
Right.
than meets the eye when it comes to commercial real estate.
Absolutely.
Yeah.
There are so many nuances and variables to consider. That's why due diligence is so important.
Yeah.
You can't just, rely on headlines or catchy phrases. You need to dig into the details.
Right.
Understand the local market.
Right.
And think critically about the long-term prospects.
Well, we've certainly done some digging today, haven't we?
Yeah, we have.
We've talked about market sentiment, construction loans, childcare centers, and even the surprising appeal of Dollar General.
It's interesting.
But there's still one more listing in this newsletter that I want to get your take on. Remember those medical properties we mentioned earlier?
Yeah.
A 6,720 square foot NNN medical building.
Okay.
And a 12,500 square foot NN medical building.
Right.
I know those terms might sound like alphabet soup to some listeners.
Yeah.
But they're actually pretty important in the world of commercial real estate.
They are.
Can you break it down for us?
Sure. NNN stands for triple net lease.
Okay.
Which means the tenant is responsible for paying not only the rent, but also the property taxes, insurance, and maintenance expenses.
So less risk for the landlord.
Exactly. That's why these types of leases are often seen as more attractive to investors. They offer a more predictable income stream with fewer surprises.
Right.
But that also means they typically command a higher rent premium.
Okay, so NNN and NN leases can be good for investors.
Yeah.
But why are medical properties attracting attention in the first place?
Well, healthcare is a sector that tends to be resilient.
Okay.
Even in, economic downturns.
Right.
People need medical care.
Right.
Regardless of what's happening in the, stock market.
Yeah.
And as the population ages, the demand for healthcare services is only going to increase.
So it's like a built-in safety net.
In a way, yes.
Okay.
But it's not a guaranteed win.
Right.
Investors still need to do their homework.
Right.
Who are the tenants in these medical buildings?
Okay.
Are they established medical groups with solid reputations?
Right.
What are their lease terms?
Okay.
And what's the overall healthcare landscape in that particular area?
Right.
Is there a growing population?
Right.
Is there a need for specialized medical services?
So it's not just about buying any old medical building.
Right.
You have to understand the nuances of the healthcare market in that specific location.
Precisely. And you have to consider the potential for future changes.
Okay.
What if a major hospital closes or relocates?
Right.
What if new technologies, disrupt the way healthcare is delivered?
Right.
Investors need to, think long term and anticipate potential challenges.
That's a lot to wrap your head around. It seems like every property type comes with its own set of complexities and considerations.
It definitely does. That's why it's so important to have a knowledgeable team on your side.
Right.
A good broker, lawyer, and accountant can help you navigate the intricacies of commercial real estate. Yeah. And make informed decisions.
Well, we've covered a lot of ground in this deep dive.
We have.
We've seen a potential shift in the Texas commercial real estate market.
Yeah.
Promising opportunities and growth, but also inherent risks and complexities.
Right.
What are your final takeaways for our listeners?
I think the biggest takeaway is that due diligence is absolutely essential.
Right.
Don't get caught up in the hype.
Right.
Or rely on, catchy phrases. Dig into the details.
Right.
Understand the local market dynamics.
Right.
And consider the long-term prospects.
Right.
And don't be afraid to ask questions.
That's great advice.
Yeah.
And remember, this newsletter from Eureka Business Group gave us a snapshot of the Texas market. Yeah. But real estate is hyper-local.
It is.
What's happening in Texas might be completely different from what's happening in your own region.
Absolutely. The same principles apply.
Right.
But the local factors will vary widely.
Right.
So do your research.
Yeah.
Talk to local experts and understand the trends in your own backyard.
And hey, if you're really feeling ambitious, maybe even start your own deep dive into the exciting world of commercial real estate.
There you go.
Who knows? You might just uncover the next hidden gem.
That's the spirit. Always stay curious.
Yeah.
And never stop learning.
Couldn't have said it better myself.
Right.
Thanks for joining us on this deep dive into Texas commercial real estate.
My pleasure.
We'll be back soon with more insights and analysis from the world of business and finance.
Sounds good.
Until then, happy investing.